It's a random Tuesday. You check your account and notice something unusual. There's $100 sitting there that you don't need for rent, food, or anything urgent. And for the first time, you think, okay, this is it. Time to start investing. So you open YouTube, and within 30 seconds, you're staring at thumbnails that say things like, turn $100 into $10,000 in 30 days. Or, this penny stock is the next Amazon. Or my personal favorite, one crypto before it explodes. And you think, I just want to do this the smart way, without setting my money on fire. Here's the thing, $100 is enough to start, but it's also the exact amount that beginners burn chasing shortcuts. And when they lose it, they don't just lose the money, they lose the confidence, the momentum, and sometimes the whole idea of ever investing again. So this video is going to do two things. Show you the actual smart plan for your first $100 and explain the psychological traps that cause people to blow it before they even get started. Let's go. Before we talk about where to put the money, there's one question you need to ask yourself. If something unexpected happened tomorrow, a car repair, a medical bill, anything, would you need this $100 back immediately? Because if the answer is yes, investing is not step one. The Federal Reserve found that when faced with a $400 emergency, about 37% of American adults couldn't cover it with cash, and 18% said the largest emergency they could handle was under $100. If a surprise expense forces you to sell your investment at the worst moment, investing didn't help you, it hurt you. This is why I want you to think about your money in 3 buckets before you do anything else. Bucket 1, safety. Bucket 2, high interest debt. Bucket 3, actual investing. Here's where it gets interesting. Most people skip straight to bucket 3. But bucket 1 is the one that keeps you from panic selling everything at a loss 6 months from now. If you have zero emergency savings, the smartest first move might actually be putting that $100 into a basic savings account. Not a brokerage account, not a crypto wallet, a savings account. I know, that sounds boring. Stick with me. When financial stress hits, and at some point it will, your brain doesn't calmly analyze long-term returns. It screams, I need cash now. That instinct has a name, loss aversion. We feel the pain of a loss roughly twice as intensely as we feel the pleasure of an equivalent gain. It's hardwired into us. And it causes beginners to panic sell at exactly the wrong moment. A small emergency buffer can prevent that. Think of it as investing in your ability to stay invested later. That's not a consolation prize. That's actually strategy. Fix the hole first. Now, bucket 3. This is where things get good. Let's assume you have at least a small buffer, no urgent high interest debt, and you can leave this money alone for a while. Now we invest. And I'm going to be blunt. Your first $100 should not go into individual stocks, meme coins, or penny stocks. Could you get lucky? Sure, but that's not investing. That's lottery behavior, and the difference matters. The smart approach is simpler and, honestly, less exciting than you're hoping. You buy the entire market at a low cost. That usually means a broad index fund, something like a total market index fund, an S&P 500 index fund, or a target date fund. Here's why this matters. Research has consistently shown that over long periods, the vast majority of professional fund managers, people paid full time to beat the market, fail to outperform basic index funds. If professionals with teams of analysts and decades of experience can't reliably do it, a beginner making a $100 trade definitely isn't going to crack the code. Index funds let you own a tiny piece of hundreds or thousands of companies at once. When the market goes up, you go up with it. When it drops, you're not wiped out by a single bad bet. Boring? Yes. Effective? Extremely. So here's exactly what doing this looks like. Step 1, choose the account. In most countries, the best order looks something like this. Employer retirement match first, if that's available to you. Then a tax advantage retirement account. Then a regular brokerage account. The names differ by country, but the principle is always the same. Use the most tax efficient and lowest fee account you have access to. Step 2, choose one fund. Don't overcomplicate this. Pick one diversified index fund, a total market fund, an S&P 500 fund, or a target date fund that automatically adjusts its risk over time. One fund. That's it. Step 3. Invest the $100. Most modern brokerages allow fractional shares, meaning you don't need to wait until you can afford a full share. You put in $100 and you're in. Step 4. Automate the next contribution. This is the real secret, and most people completely miss it. Your first $100 barely matters in isolation. What matters is the habit. Here's a number that should reframe everything. If you invest $100 once and never touch it again, at a 7% average annual return over 30 years, you end up with about $760. Not exactly life-changing. But if you invest $25 a week for those same 30 years at the same return, you end up with roughly $120,000. Not because you were a genius, because you were consistent. That's the whole game. Automation beats motivation every single time. Set up an automatic transfer, even $10 a week, and let it run. You stop thinking about it. It just keeps building. One more thing. Fees. Fees are boring, which is exactly why they're dangerous. Some actively managed funds charge around 1% per year. Many index funds charge around 0.05%. That difference sounds almost invisible. But over decades, the compounding effect of that fee gap is enormous. A low-fee fund can end up more than 30% larger than a high-fee fund over a long period, all because of that difference. Boring numbers. Huge consequences. So why doesn't everyone just do this? If the plan is this simple, what's the problem? Your brain. Your brain wants excitement. Index funds feel boring. Trading penny stocks feels exciting. Your brain hates being wrong. So when an investment drops, you panic and sell. Your brain wants control. So picking individual stocks feels smart, even though research says it usually isn't. The irony is that doing less, buying the market, automating contributions, and mostly ignoring it is often the winning strategy, but it feels passive. It doesn't feel like you're doing anything. And that friction is where most beginners bail. So here's where we come back to that $100 sitting in your account. If you have no emergency savings, start a buffer. If you have high interest debt, pay that down first. If you're genuinely ready to invest, put in a low-cost broad index fund and immediately automate the next contribution. Even if it's small, then keep it boring. Keep it consistent. The people who build wealth over time aren't the ones who found the perfect stock or timed the perfect entry. They're the ones who built better systems and stuck with them when it felt like nothing was happening. One day you'll look back at this first $100 and realize something. The money wasn't the most important thing that changed. You were. If this helped you, hit subscribe and drop a comment below saying, I'm starting with my first $100. I read every single one. And I'll see you in the next one.